Let's look at the stock markets. In fact, this is one of the most important part of the architecture of any financial markets and institutions across the globe, right? Pretty much every country has a stock market, and you can intuitively back of the envelope. You can look at just the how developed the country is in economic terms, and how developed its stock markets are, and you'll see a correlation. And it's not a coincidence because the stock markets, they allow that moving money across time, across people, across the states of the world, they allow you to do those things in a very efficient manner, which what that does, it allows your economy to become more productive. It allows firms to take a lot of projects that they might not have otherwise taken had they not had the access to stock markets. So in the US, for example, you talk about New York Stock Exchange, you talk about NASDAQ, you talk about Amex. Internationally, you have London Stock Exchange, Sao Paulo, Shanghai, Mumbai Stock Exchange, and so on. But the point is, in fact, I'll encourage you to go to any of these stock markets, maybe the stock markets in your country, go to their websites, and look at some of the institutional details. It should be a fun exercise to do and learn about how exactly they operate. But no matter where you look at it, London, Sao Paulo, Mumbai, US, the key idea remains the same, that these markets are trying to move money across people. When we buy and sell shares, that's what we are doing. We may not be thinking like that, but essentially every time that there is a transaction in the stock market, we are moving money across people. We are allowing investors to diversify their investment, as we saw earlier, by buying different different stocks in our portfolio. We provide liquidity to investors, right? So imagine if you bought a share in a company that is privately held, that is a company whose stock does not trade on the stock market. Then you do not have that kind of liquidity. But if you buy a share in IBM, and if you tomorrow need cash, you just go and within a second, you can sell your stock and get that liquidity, right? And overall theme is it improves the stock market, that is, improves investment in the entire economy through better risk sharing and liquidity. Because as investors we have liquidity, because stock markets give us the ability to diversify our risk, because of those fundamental reasons, we are happy giving our money to company through a stock market, which in turn means that company has now got the resources to invest in a positive NPV project. And therefore, the GDP of the country or the investment scenario of the country improves. That's the key idea behind these stock markets. Okay. Now, I'll give you some details so that we are clear about broad functions of stock markets. And you'll hear about stock markets as being classified into primary market and secondary market. Primary market are essentially new issues or shares that are sold by the company to the investor. So the best way to think about that is that when a company issues, say, an initial public offering, right? That is the time when company is directly selling shares to investors, and that money goes to the company directly. That we'll call primary market. Secondary market, on the other hand, is when existing shares are trading on the market. So today, when you log in, let's say to New York Stock Exchange or to your brokerage account, and when you see shares are being bought and sold, there are transactions in the secondary market. Yeah? And firms raise money in the primary market, and then they list their shares on one of these exchanges, and then the trading begins in the secondary market. That's how you want to think about it. So that's one way to think about a stock market. The other important way or other important feature of stock markets is to think about the key actors, key players in these markets. In particular, I would like you to learn about dealers and brokers. A dealer maintains an inventory of stocks and stands ready to buy and sell. So this is how a dealer will look. Let's say if I am a dealer of IBM stock, then at any point in time, I'll have some inventory, a lot of IBM shares with me. And I'll give you two sides of quote that, hey, if you want to buy from me, I'll sell it to you. If you want to sell it to me, I'll buy it from you at two different prices. Yeah? But then I'm making markets. I'm providing you this service that anytime the market is open, my shop is open, and I can buy and sell. I'll do both sides of the transaction depending on what you want. Right? A broker is another intermediary in the process. And a broker is essentially an agent who brings buyers and sellers to the dealers. Essentially, you can think of broker bringing buyers and sellers together, but they typically do not maintain inventory the way dealer does. So broker will essentially be going to the dealer. So I'll be talking to a broker, and broker will be going to a dealer, and then the trade will happen. Yeah? So these are the players that kind of facilitate liquidity and trade in financial markets, in the stock markets to be precise here. And then the another thing that you'll often hear is the bid and ask price. So you'll see two quotes, right? Whenever you look at any stock price, you'll see there is a bid price and there is an ask price. The price at which the dealer is willing to buy from you is the bid price. And the price at which the dealer is willing to sell to you is the ask price. And naturally, you can see now where dealers make money, that they'll have the price at which they will buy from you will be different from the price at which they will sell it to you. They'll buy a little bit cheaper at the same point in time compared to the price at which they'll sell it to you. And this is called the bid-ask spread. And that is the compensation, or that is the money, or that is the profits that dealers make by providing liquidity in the market to everyone. Yeah? So these are primary and secondary market. Dealers and brokers, bid and ask price. These are some of the important things that you want to learn, you want to remember when you think about the stock markets. And I strongly encourage that you go visit some of these websites and look at some of the stock quotes and look at some of the stock exchanges and some of their white papers where they give a lot of information about how precisely they are structured. Across country, you'll see some differences in how these things are structured, but broad principles will remain the same. So for example, let's look at Apple's stock price chart. You immediately notice for stocks, there is a lot of trading, especially for a stock like IBM, right? For large, big stocks, actively traded stock as we call them. You'll see price changing when the markets are open. Prices will be changing every second, every nanosecond these days, in fact, right? And you'll get some important information just by learning, just by looking at some of these charts. First of all, you notice that there is volatility in a stock price naturally. What happens as information comes, the traders, investors, they update their belief about how good these companies are, what's the forecast of the future cash flows, how much risk is there in this company. Every item of news affects your thinking about those things, and the prices keep changing. Yeah? So that's the first thing that you want to see. Immediately, you'll also see that for a liquid stock, the price quote that you'll be getting would be very frequent. And I'll come back to this point when I talk about bond of, again, Apple. But just look at this chart right here. Look at the ups and downs that you see in the Apple's stock price. And I'll compare this later to Apple's bond price. So just keep that in mind. Also, it is important to look at some of the key numbers that the stock chart often give you. Of course, high and low is self-explanatory, right? In a given time period, it tells you how much has been the range, what has been the range of a stock price. And they'll give you some important metrics on the shares outstanding and the market capitalization. That is, the market capitalization here, $622 billion, is the market value of equity. Remember, we were talking about that for a company, you look at the market price of share multiplied by number of shares outstanding. So you get some idea about how big the company is. And then you'll get something called price earnings ratio. That is simply giving you for $1 of earnings per share, what is the price? So a stock price divided by earnings per share, right? And higher this number, essentially market is paying you more price for a given dollar of earnings, yeah? And then you'll have a bunch of other characteristics, and I'll focus on one before going any further, called the beta. And this should sound familiar to you. This is the measure of systematic risk of the company's stock. This 1.29 tells you that the stock price of Apple moves about 1.3 times more when S&P 500 moves by 1 unit, right? 1.3 means the ups and downs in Apple's stock is a little bit higher, 30% higher than S&P 500 as a whole. So take this as a homework exercise. Pick your favorite stock and look at their stock quote and try to learn about these things and try to see how prices move, and sometimes look at big price movement in this chart and see what moved that price. That should be a very good exercise, very instructive to learn about the stock prices.